Welcome. Thank you for taking the time to tune into the 1015 Associates 2015 Market Forecast presentation. For those of you that don't know who I am, my name is Debbie DeMatteo. I'm the lead portfolio manager, vice president, and co-founder of 1015 Associates. For those of you that had hoped to attend our live presentation at the Westchester Dinner Theater, we apologize for the inconvenience. Given the weather forecast that we had for that evening, we thought in the best interest of all of our clients, our staff, and the staff of the Westchester Dinner Theater to not have people on the road was in the best interest of everyone. So instead, I thought it would be nice to invite you into my office, and we'll spend the next 40 minutes or so going over the presentation that we would have done live at the Westchester Dinner Theater. So that being said, we're going to do as usual. We're going to talk about what happened over the past year, where we are presently, and probably most importantly, focus on the things that we think are important for the year 2015. 2014 brought a year with the S&P 500 closing up 11.5%. 10-year Treasury rates closed at about 2%. Gold was down marginally, and the emerging markets lost about 5%. If we look at the major developed economies around the world, the U.S. came out well on top. The markets, as I said, finished up about 11.5%. Japanese markets were only up 7%, and the European Stoxx 600 was up 5%. We find ourselves here in the United States of what many people are referring to as the cleanest dirty shirt in the laundry. That although our economy is not growing well by any stretch, we're certainly doing very good compared to the economies around the world. If we look at the components of some of the markets, developed markets around the world, you can see that in the Eurozone, they're facing still double-digit unemployment. It's very hard to get the economy on track when you have more than 10% of your people unemployed. And in Japan, they're still plagued with almost no growth, zero interest rates, and no inflation. It's an economy that is battling a very difficult demographics and has had a stock market that has gone nowhere for 25 years. So here in the United States, with growth at only about 2%, we still look like one of the best economies around the world. If we look at the difficulty of making money over 2014, the S&P 500 is a little bit misleading. That if you had a diversified portfolio and had exposure to specific sectors or had your money invested in different parts of the world, it was a much more difficult year to make money. As we said, the S&P 500 was positive. The world index, though, showed only a return of less than 5%. The emerging markets were down 5%, and if we look at the European index as a whole, it was down almost 10% last year. The U.S. markets were dominated by Fed talk, and the Federal Reserve has been a big part of the U.S. economy since the recovery in 2009. We started out with traditional policies that the Federal Reserve brought interest rates all the way down to zero. They reduced bank reserve rates, allowing banks to lend more money. And then we moved into, in 2014, quantitative easing, which is more unconventional Federal Reserve policy. It was a bond buying program that ended earlier this year. Now we're moving into what the Federal Reserve, led by Janet Yellen, is now referring to as forward guidance. Their ability to help give the market guidance of moving from a period of quantitative easing into tightening. We'll talk about that a little bit later. There's a lot of skepticism surrounding how we got to this recovery, and that a policy of zero interest rates has caused a lot of dislocations in the financial markets. One is that the increased in present cash flow valuation. So you can value stocks in a number of different ways. One of them is to take a discounted cash flow of future streams of income. So if we look at the dividend income that a stock could create over the next several years, you discount it to its present value using a current interest rate. Well, those of you who have retired from companies like Verizon and other companies that offer lump sum pensions are familiar with the idea if we use a lower interest rate and a discounted cash flow model, you get a much higher valuation. So arguably, we could be placing higher values on stocks today because of the low interest rate that goes into a discounted cash flow model. In addition to that, this causes investors to move into higher risk assets. Investors first moved out of low cash paying deposits such as CDs and banks moved into bonds. But as the Federal Reserve pushed long-term interest rates lower, even bonds don't offer a very good alternative in today's markets, pushing investors further out on the risk curve, buying stocks where at least their dividend yield is a little bit higher than what they could get on bonds or in CDs. And of course, there's also the idea of financial engineering, that with businesses not actually growing revenues, they've been able to grow earnings by cutting their costs. One of the largest cost factors for many companies is their debt service. And companies have been very effective at reducing the cost of their debt by refinancing billions of dollars of debt that they've been carrying, thereby allowing them to show higher earnings, although they haven't actually grown revenues. So as we move from a period of zero interest rates and Fed stimulus to a period of tightening, as interest rates rise, we'll have to see what the impact on the reverse of quantitative easing actually is. I think one of the biggest surprises for 2014 is the interest rate markets. When we came into the year, 10-year Treasury rates were hovering right around 3%. And by all estimates, it was expected that interest rates for the year were going to rise. We knew that the Fed was going to be pulling away from quantitative easing. There was a sense that the economy was getting better and that we'd start to return to normalcy. But as you can see, at the end of the first quarter, interest rates actually declined. And we could easily justify that because we had a first quarter negative GDP. There were signs that the economy was maybe slowing, so investors were moving towards safety, so we could justify those lower rates. We also had a correction early part of 2014. Then we get to the end of the second quarter. Market continues to make new highs, yet interest rates continue to drop further. Well, we did have the Russian annexation Crimea, lots of global unrest. So again, the idea that maybe investors were moving toward more safety and buying U.S. Treasuries. End of the third quarter, stock market continues to make new highs, yet interest rates continue to go down further. That was the first sign of troubles in the oil market. We started to see oil prices roll over. Declining oil prices are very often a signal of a coming recession, so we could justify the fact that interest rates were heading lower. And then once again, we ended the year, interest rates just over 2%. By all expectations, we would have been much further in the other direction with a lot higher interest rates. The confusing thing about this for 2014, that a higher market is indicative of things getting better, but lower interest rates are indicative of things not improving. So as a year of much cross signals, very difficult to read what was going on. One of the things that remained very constant was the fact that the market seemed to continue to trudge higher in light of all of the news that we got, whether it was news of Ebola or the Russian invasion of Crimea. Things just continued to smoothly go up in the markets. And a statement that came about is the most notable thing in the financial markets today is the absence of anything notable. When we were together in July, we talked about the lack of volatility. And it's unusual when you have so many things going on in the market that the market just seems to move along slowly. This line here, the flat line, indicates normal volatility or the historic level of volatility in the financial markets, running at about 20. This is just a graph of the year 2014. And you can see in late August, early fall, right here on the chart, that we had a spike in volatility, very short-lived. Then during October, we had a 10% market correction and volatility spiked once again. As we moved into the end of the year and the commodities market started to show some real signs of weakness, we had volatility spike once again at the end of the year. But if we pull this out to a bigger picture, and for those of you that know me and I'm talking about volatility, there'll certainly be a reason why. This much larger time frame, this runs back to 2003, gives you a better indication of what volatility is. The green line here on the chart indicates the S&P 500. And you can see from the 2007 highs to the 2009 lows, we had a threefold spike in volatility. The markets calmed once again, and then in 2011, with fears of a European meltdown, volatility spiked twofold once again. So even the volatility that we saw in 2014 barely shows as a blip in a longer-term range of what market volatility has historically been like. So where are we today? Let's talk about the state of the U.S. economy, the monetary policy, deflation, slower growth in China, lower oil prices, and fiscal policy. One of the themes that we've talked about very often is the lack of the recovery to the average household, or what I call the working class in the United States. We have seen a recovery in the financial markets. We've seen a recovery to the wealthy, and even the more educated are doing a little bit better of getting good jobs. But the working class in the United States has yet to see a recovery. Although we see that the unemployment rate is near normalized levels, with the labor force participation rate dropping to 30-year lows, it's very misleading what the economy really looks like. So let's take a look at what those numbers are really indicating. And I want you to focus in here on this back half of the chart. We've had 3 spikes in unemployment over the last 25 to 30 years. Back in 1987, after the market crashed, we had a big spike in unemployment, which subsequently we recovered. We went down to a low of a 4% unemployment rate in this country, right about the year 1999 into 2000. At the time, we didn't know it, but that was also the peak of the labor force participation. After the financial crisis, we had a huge spike in unemployment. As things have recovered, we have not yet seen a recovery in the labor force participation. What this chart really shows us is that back in 1999, when we had a 4% inflation rate, a 4% unemployment rate, at the same time that we had high participation in the labor markets, that's a very different economy than one with a 6% unemployment rate and labor force participation at 30-year lows. This chart is very telling, and we like to look at what are some of the signs of improvement out there. There has been wage growth in only 3 major economies around the world since 2009, in France, Germany, and in the United States. In the United States, the wage growth has only been less than 1%. And the interesting thing about that statistic, though, is that 0.8% of the wage growth came between September of 2013 and September of 2014. Meaning all of the wage growth is in very recent years. This could be indicative of things beginning to get better in the United States. We can also see signs of improvement in the housing market. Housing prices are recovering. What's disappointing, though, is that the number of people in the United States, or the percentage of people that are homeowners, has declined quite significantly. The 10-year average is around 70%. Today, it's less than 65% of the people in the United States own a home. So although housing prices have recovered, there's fewer people benefiting from that. The last time home ownership was under 65% was back in 1995. 1995 was the beginning of one of the biggest housing booms in the United States. So maybe as we begin to put some of those people back into homes over the next several years, we'll start to see a real recovery in the housing market. We've also seen a major recovery in the budget deficit. We were running a $1 trillion deficit just 4 years ago, and we've cut that in half. So it's certainly a step in the right direction. Our country is still in a significant amount of debt, and we're running $18 trillion in debt at this time. However, if you look at it as a percentage of GDP, it's about stable from where we were a few years ago. So although I wouldn't say that's improving, it's at least not getting worse. The Federal Reserve, and we can say that the Federal Reserve has stolen a page out of the fast food industry. They've supersized it. The Fed balance sheet over the last 7 years has grown from less than $1 trillion to almost $5 trillion. On this chart, you can see the growth. The red bar indicates the Fed buying of U.S. Treasury bonds. They've purchased over $2 trillion of U.S. Treasuries over the last several years. In addition to that, on the top here, the blue line, they've purchased $1.5 trillion of mortgage-backed securities. You know, when we start talking about billions and trillions, it's really difficult to get your arms around what that number really means. Well, a little less than $5 trillion is equivalent to about the net worth of 57 Bill Gates. So maybe it puts it in a little bit more perspective. The Fed intentions, and I find this interesting. Under the new leadership of Janet Yellen, she has vowed to communicate their intentions to the markets. and guide the markets from a period of stimulus to a period of tightening. And she thinks she'll be able to smooth the waters and bring us, very smoothly to a very different era of Fed policy. Well, I'm going to read a statement from the Federal Reserve from back in 2014 in September. And again, maybe, I don't know if any of you have listened to Janet Yellen speak, but maybe if you think of it in her voice, it will bring more clarity and certainly feel a little bit smarter. But let me give it a whirl here anyway. Turning now to our plans regarding the Fed's balance sheet, the committee intends to reduce securities holdings in a gradual and predictable manner, primarily by ceasing to reinvest repayments of principal on securities held in the system open market account. Regarding the timing for ceasing reinvestments, the committee now expects this to occur after the initial increase in the target range for the federal funds rate. Well, I don't know about you, but I certainly feel I've got it. That I certainly feel much better about Fed policy, and I have a really good handle on where the Fed is going to be going. This is the type of commentary that the market will listen to every word that is uttered in 2015 and try to figure out where exactly the Federal Reserve is going to go. Monetary policy and monetary easing is not leaving, it's just simply moving. The economies in the United States and the United Kingdom are about ready to begin tightening. However, in Japan, Europe, and China, the party is just getting started. We know now within the last several days that Draghi in the European zone has committed to a quantitative easing program much similar to those that our Federal Reserve embarked on in the United States. In Japan, and again, we mentioned that this is an economy that's been basically in a recession for over 20 years. Their stock market is down 50% over the last 25 years, and they're pulling out no stops. They have doubled down on their quantitative easing. They're buying a lot of assets, and they've had a zero interest rate policy for many years now. China, for the first time in 2 years, has lowered their interest rates in an effort to stimulate their economy. My question is this. We embarked on quantitative easing in order to lower long-term rates in the United States to stimulate our economy. European interest rates are far below U.S. interest rates. 10-year German bonds are paying less than 0.5%. Japanese bonds are paying about 0.2%. I'm not sure what quantitative easing will do to help those economies, but it will certainly dominate the headlines as we move through 2015. China is slowing down, and this is an economy that is mammoth. And several years ago, it was the Chinese economy that pulled the rest of the world out of recession. They were growing at double-digit rates. Today, they're lucky to get 6.5% growth, and it is estimated that they will slow further, making it much more difficult for the world economies to come out of recession. I've been talking now for about 10 minutes and haven't even discussed lower oil prices. It's difficult to open up a newspaper or turn on any financial show and not hear about what's going on in the oil markets. And it's so surprising to me. We've been running these meetings for the last couple of years. We've talked more than once about the energy revolution going on in the United States, the amount of oil that we're finding and producing. We've been talking about the Chinese economy slowing down. But suddenly, we wake up to the fact that the U.S., over the last year, we're producing 1 to 2 million barrels more of oil per day than we were just a year ago. With China demanding less of it, we certainly have a lot more supply on the market than we thought we would. And Saudi Arabia, they're not going to take this laying down. The commodities market are front and center. Let's take a look at the numbers. The United States today, not at some point in the future, the United States today is the largest producer of oil in the world. We're producing over 12 million barrels a day. Saudi Arabia, just shy of 12 million barrels a day. And Russia, they come in third place with 10 million barrels a day. So who's going to be the winners and losers in this? Of course, your major exporters, they stand to lose the most. Saudi Arabia exports almost 80% of the oil that they produce. Be a major hit to their economy. The Russian economy exports about 70% of their production. The United Arab Emirates, Iraq, and Iran, They export almost 100% of everything that they produce. The U.S., China, and Japan, we are the largest importers and stand to gain the most from lower oil prices. The impact of this is yet to be fully understood, but here's some of the numbers. With the United States being both the largest producer and also one of the largest consumers and importers, the results here will be mixed. We've never been in a situation with lower oil prices in the United States where it will hurt the production of companies that are making a lot of money today producing oil. China, they're the second largest importer. They will gain $2.1 billion for every dollar per barrel that oil drops. That means the Chinese economy stands to gain a windfall of $100 billion if oil stays around $50 a barrel. It's an amazing statistic. Europe, they're definitely going to see their energy costs go down. Their biggest problem in Europe, however, is the deflation that they're fighting. In India, and it's one of the fastest growing economies around the world, they stand to benefit significantly from lower oil prices. Well, if China is going to be the recipient of a $100 billion windfall, somebody's got to be on the other side of that. Saudi Arabia, we expect right now, is a $100 billion loss in exports. They have the ability to run at a negative for a while and run on reserves, and they're willing to do that to try to push out some of the marginal producers around the world. But they will see a major decline in their economy. Venezuela needs oil prices around $120 a barrel just to meet their country's budget. Iran needs $136 a barrel, and remember, they're exporting almost everything that they make in order to pay their bills. Russia's getting crushed. This is an economy that's been growing for the last 15 years, really seen its people prosper, but 40% of their economy is driven by oil. Right now, the Russian economy is headed full force into a major recession with oil prices where they are today. Let's talk about fiscal policy. We've met like this for the last several years, and all we've talked about is what is our Federal Reserve going to do to bring our country out of these problems. Have we forgotten about Washington? Have we forgotten about the ability of our Congress and our President to come up with legislation to stimulate the United States economy? We're in a situation today, we need Washington to act. We need Washington to come up with bipartisan legislation that will bring back the optimism in this country. We've got a lot of problems that we're going to face. We need to budget again. We're going to fight the debt ceiling debate once again. And this will all be played out in the media. And of course, the market is always in the crosshairs of all of the debate about what they're going to do to fix fiscal policy. I've sat and listened to about a half a dozen bills that will be brought to the president's desk. Most recently, the Keystone Pipeline that was passed by Congress that will be vetoed by the president. I'm not sure that I could run my business by spending time coming up with strategies that would never see the light of day. We need Congress to act. We need Congress to give people the belief that they live in a country with a government that they can trust, a country they have the ability to prosper in, and an economy that they have confidence in. You know, I grew up working class poor, and at no point in my lifetime, either during my adolescence or my adulthood, did I ever feel that I had a lack of opportunity. Unfortunately, in the last several years, the youth in this country and anybody that was displaced from the financial crisis, they've not only felt a lack of opportunity, they've lived a lack of opportunity. With the Federal Reserve stepping away, it's time for the Congress and our president to come up with bipartisan legislation to move the people in this country forward. So how are we going to get there? What's going on? What are the estimates for growth in the coming year? And what are the CEOs of the big companies thinking about as we move into 2015? Well, with all the work that we've done, the United States is hoping to grow at 2.5% this year. China, 6.5%. India could be a very interesting place to keep an eye on. They've got a population the size of China, and they're growing at 5.5%, and with the tailwind of oil behind them, could be a major player in the world economy going forward in 2015. Each year, the strategists take a look at what are the things that would affect the economy in the United States most negatively or most positively. And it's interesting that this year, they feel that the biggest risk to the U.S. economy is actually a global event and something that would slow down global, worldwide economic growth. That's the biggest threat to the United States. The tough part about that is we have very little control on what goes on outside the borders of the United States. So what do we need to pay attention to? Europe. We forget the European economy in terms of GDP is actually larger than the United States. So what happens in Europe really matters. And they are struggling. They're teetering on the brink of recession. The European economy, they are fighting deflation. And we think as consumers, so what's the problem of lower prices? I love pulling up to the pumps and getting lower gas prices. I wouldn't mind buying something for a lower price. Well, deflation is a spiral to the downside for an economy. If I was going to make a major purchase, maybe buy a new home or a car or a washing machine, and I felt that I could buy it cheaper next month or 2 months from now, I'm not going to make that purchase. I'll put it off. And that just spells disaster for any economy around the world to fight deflation. And the real problem is that in order to fight deflation, we typically lower interest rates. Interest rates are already near zero. There's not going to be a tool that they have in order to fight deflation. So we need to see real economic growth coming out of Europe if we're going to see that economy get better. The commodity slump. You know, we as consumers, it's 100% benefit to us, period. But the emerging economies around the world depend on oil to pay their bills. And what the markets are afraid of right now is the potential that either several large businesses or possibly a country defaults on their debt. If, for example, Russia didn't have the ability to make good on their debt, it would create a shock in the credit markets. The credit markets are the bond markets. The bond markets are the lifeblood of all the world economies. It's all about the ability of access to credit. And if those businesses who need access to credit cannot get it, that shuts things down. It's what happened during the financial crisis when the housing market went bad. The oil markets are nowhere near the size of what the mortgage market was. But when the bond market stops functioning and liquidity dries up, it causes problems long beyond just the oil markets. So paying attention to what's going on, what we'd really like to see is some stability in the oil markets. Oil prices low enough that it helps the consumers, but high enough that it keeps most of these projects profitable. On the other side of that, lower gas prices could be one of the greatest catalysts to the working class that we've seen in years. It's estimated that for every penny that gas prices decline at the pumps, the U.S. consumer saves $1.25 billion. That's $125 to $150 billion tax cut to the U.S. consumer, and I say to those who need it most. So lower gas prices could be a huge benefit to those of us who pay at the pumps. Syria civil war. This could escalate, could move over into places like Jordan and Lebanon, causing tensions in the oil markets. And again, one of the most confusing things is when prices are moving around too quickly. We've dealt with oil prices declining. A huge spike to the upside suddenly would probably not be good either. But we always talked about fear premiums in the oil markets. That could return if there were problems due to the Syrian civil war. Russia, arguably, they're becoming desperate. And if they intensify their activities in the Ukraine, it could lead to further sanctions from Russia, from the United States and Europe on the Russian economy. Russia could and has threatened to retaliate by not shipping natural gas to Europe. That would stifle the European economy and cause major problems to an economy that is already having trouble. China's slowing down. We talked about that already. And there's been a lot of skeptics about how good or how bad the Chinese economy really is. And one of the risks is that there's an interruption in the Chinese economy and they slow down by more than we thought. Many of you probably saw the 60 Minutes piece that showed full cities in the Chinese economy that nobody can afford to buy and they're not inhabited. There could be a potential housing crisis in China that would dwarf anything that we saw here in the United States. A massive decline in the Chinese economy, if China were to slow by more than 2 percentage points over the next 2 years, it's estimated that that would shave 0.5 percentage off of worldwide growth. Now, if you're growing at 5 or 6% a year, 0.5 percentage point is not a big deal. But if the world is struggling to grow at 2 to 2.5, 0.5% cut would be significant to the worldwide economies. We're going to watch the politicians play as usual. The Federal Reserve is going to be talking about Fed rate hikes. The U.S. politicians are going to be talking about fiscal policy. All of this will be played out in the crosshairs of the markets and will certainly lead to volatility as we make our way through 2015. There are a lot of positives. As much as we talk about some of the negatives and things that could harm the economy, if we are on the verge of a housing boom, better housing, that's a lot more jobs, that'd be a big boost to the economy. Lower gas prices, huge boost to the economy. Lower interest rates, very stimulative to the economy. Consumers have been spending the last several years paying down their debt. If we're finally at the end of that and the consumers are willing to reach into their pockets and start spending. How about capital spending by corporations? We've talked a lot about all the cash that they've got, but their lack of willingness to spend. If we finally make that transition from a Fed-driven economy to an actual consumer-driven economy and an actual economic recovery, things could be a lot better than we expect in 2015. As a matter of fact, there's a lot of people that believe the surprise of 2015 will be much better than expected growth in the United States. That's why the consensus coming into the year is that the markets will, in fact, rise another 10% in 2015. Consensus estimate says the bull market, the fourth longest in history, will continue to stay on track. There's a saying on Wall Street, bull markets don't die of old age, they die of a recession. There's no red flags right now that the U.S. is headed right into a recession. It's an economist that's very well respected. As a matter of fact, he's the top-rated economist for 35 years. There's nobody else that can take that rank. So when he talks, people tend to really listen to what he has to say. I listened to his yearly forecast this year. And what he had to say is that the U.S. and the U.S. markets are in the very early stages of a very long recovery. So we could have a couple of really good years still in front of us. It's all about earnings. The S&P 500 is expected to grow earnings this year by about 7.5%. We pay up for stocks based on a multiple of their earnings. We're in the heart of earnings season right now. And we've seen a mixed bag. We're certainly seeing some great earnings from certain industries that people had kind of counted out, industries that are long line and hire a lot of people. So if we do see earnings growth, we could continue to see the market go higher. It's all about, is the market expensive or not? This is a chart of the PE ratios. Now, I know most of you don't like to talk about things like multiples, but it's all about what is expensive and what's not. So if we go back to 2004, the market was trading at about 18 times earnings, meaning individuals were willing to pay $18 for every dollar of earnings. Back in 2004, 10-year Treasury rates were at 4%. Today, we're willing to pay up about 15 or 16 times earnings, but the alternative, 1.8 in 10-year Treasuries. So it's always what is expensive relative to the opportunities. So if I could put my money in a Treasury paying 4, that might look like an opportunity. But today, at less than 2%, makes the stock market still look relatively inexpensive. So there is still the potential of further upside from here. What are CEOs thinking? Well, interestingly, in the United States, optimism has been waning. Quarter by quarter, the people who run U.S. companies, their optimism that things will get better has been declining. And those that think that things will get worse, those people, the number of those people have been increasing. However, there is some good news in those statistics. The industries that feel that things are going to get better happen to be in construction, services, and IT. Why that's important is that those are the industries that typically offer much higher paying jobs. And when we looked at that chart that talked about wage growth, there is tightness in the labor force, especially in some of these industries where we could start to see some real wage growth. When we look at the CEOs around the world, and remember us being about the least dirty shirt in the laundry, around the world, CEOs are growing. They are much more optimistic than we are here in the United States. So maybe it's time that the rein will change hands from the United States to better things ahead in the foreign economies. And remember this, our markets have done phenomenal over the last several years in anything but a really strong economy. The markets tend to anticipate growth in the future. So maybe the foreign economies will begin to look forward, and where the opportunities in the markets may come from abroad. The earnings in Europe in the third quarter of last year grew by 15%, while here in the U.S., they grew by 10%. So as our economy strengthens and our businesses look forward to better times ahead, around the world, those companies are looking where we were just several years ago. So to sum it all up, I would expect that 2015, the way we've opened up this year so far, with a lot more volatility than we've seen, that will dominate the markets for the year to come. Volatility is not necessarily a bad thing. Volatility to us in money management typically breeds opportunity. So volatility is not necessarily a bad thing. The trouble is that when you already have volatile markets, any type of headwinds or any type of headlines can make things get that much worse. See, think of it like this. If you're sailing along in calm waters, like we have been for the last couple of years, and the markets are just kind of trudging higher, when you get a little bit of noise around it, it doesn't rock the boat that much. But if the waters are already grown choppy, and people are a little bit more concerned, and then the winds kick up in addition to that, it's much easier to rock the boat and have a couple of people fall overboard. So that volatility could cause a market panic. And it's not going to be a disaster, but we could finally see a larger correction than we have in the last couple of years. But remember, we've been through a lot of corrections over the last several years, and the markets make their way higher. The economy in the United States is improving, and that's what we need to focus on. The real economy is getting better, and the markets will ultimately follow through. But it could be a little bit tougher going this year. Thank you very much for tuning in. I hope you enjoyed the presentation, and we look forward to seeing you in person in July.